All right. Good evening once again. Welcome to Next Gen Professional Associates, as well as welcome to another edition on on strategic financial management. In today's class, we shall continue with our questions on the materials, right? Where we have question one. We have examined the question one of uh on the materials, which is what Eco Hotel. Eco PLC, right? And KPLC is on the YouTube. You can go there and watch KPLC, right? Now, in today's class, we'll be looking at this question five. This question five is adopted from one of the ACCA past question as well as Ican, right? So, research showed that most students' performance in this question was below average, right? And you know our people like something that students did not understand, and they intend they may decide to like, oh, let's bring this question under the cost of capital, right? So that is why I decided to bring it out. So please pay attention to details as we start the analysis of this question. Don't forget, when you see a question in cost of capital, the first thing you need to do is that you read the requirement. What did they say you should do first? Once you read the required, then you ask yourself question. You ask yourself question, what topic is this? Is it APV? Is it cost of capital? Is it option pricing? Is it bond? Is it this? You ask yourself that question. So immediately you understand that, oh, this question is from cost of capital. You quickly ask yourself again, what are the steps? What are the step-by-step approach to determine the weighted average cost of capital? Of course, we have done that in our previous class, in our previous what lecture, right? And it's also on the YouTube. You can go there and watch the step-by-step approach to determine the weighted average cost of what capital. Now you can see this required now. Required. Calculate the market value after tax weighted average cost of capital of JP. Explain clearly any assumption you made. So any assumption you made, you state your what? Assumption is actually allowed. You can see calculate the market value weighted average cost. Everything is after tax weighted average cost of capital. That is what they say you should calculate. Now the question is that once it should come to your mind is what are the steps? One, you should identify the sources of finance. Two, calculate the cost of capital, which is equity or debt. Calculate the total market value and calculate what? WACC. And you are done with what? Weighted. These are the things you should know that, oh, these are the steps. Now, the B part of this question says that discuss why market value, market value weighted average cost of capital is preferred to book value weighted average cost of capital when making an what? Investment decision. The one that contains the market value and the one that does not include the what? The market value. We'll get there. Now, discuss how the capital asset pricing model can be used to calculate a project specific cost of capital, which is another part of cost of capital. We will get there. I think that one will be our next topic. Don't forget that cost of capital is like engine. If you don't understand cost of capital, forget it in SFM. Just forget it in SFM. You need to understand the concept of cost of capital. So we have dealt with like 30% or 25% of cost of capital. On Saturday, we'll look at the project specific cost of capital, which is another 25%, making it what 50% under the what cost of capital, right? Then all these systematic risks, we will explain systematic risk before now. We will equally explain business risk as well as financial risk, but we will still explain it more when we get to risk adjusted cost of capital or specific cost of capital, right? Now let's quickly go to the question without wasting much of our time. Since we have looked at the required, said we should determine the weighted average cost of what? Capital. So now let's go into the analysis of the question. Excuse me. Now, the director of Jolayemi PLC, an Abuja-based entertainment company, are currently considering the appropriate cost of capital to use in appraising capital investment. It is the policy of the company to assess the financial viability of the capital project using NPV criteria. Now, don't forget that don't forget that when you are making a capital investment project, for instance, and you want to discount that project, you could use the you can use the cost of capital, right? You can use an appropriate cost of capital, which we will get there, right? You can use the cost of capital. Either you use equity or what? Debt. Or you can use appropriate cost of capital. Appropriate cost of capital will get there on Saturday. Now, you have been provided with the following financial information. Don't forget that this company wants to go into a capital project and they want to use they want to use for them to get their NPV. They want to use NPV criteria to determine whether the project is viable or not. Of course, you will need a DCF to discount that particular project. That is why they say, oh, you are required determine the market value after tax weighted average cost of what? Capital. You can see the financial information given to us. Now, class, what are the sources of finance here? If you don't need to unmute your mic, what are the sources of finance here? Looking at this financial statement, what are the sources of finance? Quickly unmute your mic. What are the sources of finance here?
Equity,
Okay,
bonds, and
okay,
preference shares.
okay, that's fine. That's fine. Well done. So there is equity, convertible bonds, and preference shares, right? These are the three sources of finance. You can see the question just give you three sources of finance. And there is an overdraft. Overdraft, there is no loan. So you ignore overdraft, right? You ignore what? Overdraft. I didn't mean there is loan. Let me check. I didn't mean there is loan. You would have said, oh, loan is also a source of what? Finance. Now, if that is established, class, we already know that there are three sources. This question is just three sources of finance. But guess what? This question is like a trap for students. But when you understand the concept of cost of capital, you understand it, you'll be able to solve this question easily, right? Now, JP has an equity beta. JP has an equity beta of 1.2. Now, when we get to project-specific cost of capital, you will know the reason, you will know the implication of having a beta greater than 1 or less than 1. We'll get there. So these are the tools that analysts use when they want to do a stock recommendation, right? We'll get there. Now, and the S dividend market value of the company equity is what, class? The S dividend of the company equity. This is for equity, right? Is what? This is for what? This is for equity. Is what? Is 1 billion, which is the S div market value of this is what? Is 1 billion under equity. Now, the S interest. Class, what this SD market value of 1 billion? What does this indicate? I want someone that is very smart. I know everybody is smart here. Don't misquote me. I need someone that can give me an answer to this. They said the SD market value of the company equity is 1 billion. What is this 1 billion? What is this 1 billion represent? Class, what is this 1 billion represent? You can mute your mic.
Now let me try. The
Okay, try.
dividend that has been paid.
Okay, the dividend has been paid, right? We know that the
Yes.
dividend has been paid, but they said SD market value.
It actually means the total value of the equity share.
Thank you, Rachel. Thank you. It is the SD market value of they've
The
given you
market.
the total market value of equity, which means that you don't need to calculate the total market value again. You don't need it. Don't forget that. Remember that SD market value per shares times the value of ordinary shares divided by the nominal value will give you the total market value of equity. Is that not so? Now, they will not give you SD market value is given to you in the question already, which is the total market value of equity is what? Is 1 billion, right? Right? Now, the S interest market value of the convertible bonds is what? Is 168 million. You can see that the market value of the convertible bond is given already as 168 million, which means that you don't need to stress yourself and say, oh, you want to calculate the total market value for convertible bond. Now, another thing that is given again is, this is, there are three sources of finance: the equity, the convertible bond, right? Now, they now say, and the ex-dividend market value of the preference shares. So you can see the preference shares is also given. The total market value of the preference shares is what? Is also given as what? 50 million. Now, the convertible bonds of JP have a conversion ratio of 19 ordinary share per bond. Class, the convertible bonds of JP have a conversion ratio of 19 ordinary share per bond. Now, don't forget that in the formula given to you, I made mention of something that when a conversion ratio is given, there is a formula to calculate the value of convertible bond. Is that not so, class? Is that not so? Class, is that not
Yes,
so?
sir. Yes,
Yes,
sir.
sir.
Thank you. Now you can see, seeing this conversion ratio already, this should give you in that, oh, you are to determine the convertible value is not given. The convertible value is just like your principal at the end of the period when you pay your interest. When you pay your interest at the date of maturity, you pay your convertible value, which is just like the principal. Now, for you to get the convertible value, you can see that you were given the what? 19 ordinary shares per bond. Now, what next? The conversion date and redemption date are both on the same date in 5 years. Now, this question look tricky. Now, sometimes they will give you that the conversion is this, while the redemption is this. The redemption value is at par. So this is to tell you that if the redemption value is at par, which means that it's 100, which means that you need to determine the CV, which is the convertible value, right? When you determine the convertible value, you compare it with the redemption value, the higher of the what? The two. Now, in this question now, the redemption value is not given, but we're told that it is at the same date, which means that just forget about the what? The redemption and move on with the what? With the conversion. Since we're not given much information about what? Redemption. Class, the conversion date and redemption date are both on the same date in 5 years. They are both 5 years. But after that, did they give us any information about the redemption? No. You move on. Now, the current ordinary shares. The current ordinary shares price of JP. The current ordinary share price of JP is expected to increase. Is expected to increase by 4% per year for the foreseeable year. Don't forget that. What does this 4% represent? Who can try? Who can try? What does this 4% represent?
Growth.
The growth
Thank you.
rate.
Thank you so much. Thank you so much. God bless you. The current ordinary share price of JP is expected to increase, which is the growth rate of what? 4%. Now, the equity risk premium, you can see the equity risk premium is 5% and the risk return is 4%. JP, J, JP pays profit after tax at annual rate of what? 30%. Right? Required determine the market value after tax of what? Weighted average cost of what? You can see in this using under the equity now. Which value are we using? Dividend valuation method or capital asset pricing model? Class, who can tell me? We using dividend valuation
CAPM.
method?
CAPM.
Capital asset pricing model.
Thank you. Do you know why? Because anything about dividend is not given in this question. Right? You have to use the capital asset pricing model because you can see, because the element, the ingredient of calculating the capital asset pricing model is given to you. Right, class? Are we still together? Now, we will now go
Yes.
by suggested. Hello? Okay, we will now go by what? Suggested what? suggested solution, right? We'll quickly go to suggested what solution. We can have suggested solution, right? The number one is CAPM, right? Which is equity. One is equity, right? Equity. So we have to use CAPM for this, right? So we can have CAPM. Exclusive. What happened?
Sorry, good evening.
Good evening.
Please, for the sake of a presentation of these solutions, I don't know if the working should come first or the cost of equity format should come first, because I don't
I
know. I
don't I,
just need
I,
to,
I don't understand. Which format is that?
like, the work, the computation of the work, for instance, if it should
No,
come
no,
from.
you cannot exclusive. You cannot compute work without all these elements. You need to
Yes,
calculate, leave the work. Let work just stay one side. Immediately you
yeah.
finish everything, you can now
Mm.
do your work.
Yes, I get what you're saying, but I'm saying, okay, for instance, in exams, the question papers, like, if sometimes some people will say, okay, present the what's it called, the
See,
solution.
eh,
You get what I mean?
yes, exclusive.
Yeah.
See, don't even stress yourself, right? Start from the working. Just write workings. Start. Number one, ordinary shares. Start your
Okay,
workings. So once
okay,
you finish your workings like that, you can now say weighted average cost of capital
okay.
is
No
this.
problem. Thank you.
Do you understand now? No,
Yes,
do you
yes,
get?
yes, yes.
Okay,
Yes,
okay,
I
okay. We
get.
can move, right? We can move.
Yes, we can. We can.
Okay, okay. Thank you. Now, ordinary shares, which is the equity, ordinary shares, right? Which is what? Equity, right? Equity. Now, we move to, that is CAPM, right? CAPM. So what is the formula? Cost of equity equals to, now because don't forget that because in this question, risk premium is given. Don't forget that in the material, I also state that there are two formats, there are two formula. If the risk premium is given to you in the question, you have to change your formula. So we can have risk-free plus beta, right? Plus beta. Then we can have risk premium. Risk premium. Don't forget that I said, I didn't mean risk premium is not given. You would have said that, oh, risk-free minus what? You would have said market return. You would have said, oh, market return minus what? Minus risk-free, right? Now, in this question, risk premium is given to us in this question, right? So we can have KE equals to, what is the risk-free? Risk-free here is 4%.
Yes.
The risk-free here is 4%, while the premium is 5%, right? So we can have,
Return of
okay, we can
risk
have,
rate.
just put 4 plus, what is the equity beta? Don't forget that at the beginning of this question, we were told that equity beta is 1.2, right? Equity beta is what? Is 1.2, right? Equity beta is 1.2. Then the premium is 5. Don't stress yourself by putting percentage, right? So that when you just get your answer, it will give you percentage direct. So please, what is the cost of equity using CAPM? Quickly, quickly. Ha.
Wait,
So
oh,
nobody is pressing
10%.
calculator. How many percent?
10%.
Okay,
10%.
10%.
okay. Okay, please,
10%.
please, I beg. Make we deal with our calculator. Please. Now, if this is established, number one sources of finance is equity, right? When you want to determine the cost of equity given to you in the question, you are given the ingredient of capital asset pricing model. There's no there's no dividend, right? Which means that the method to use is capital asset pricing model. The next thing is to determine the total market value. Don't forget that the total market value is given to you in the question, right? Total market value is given to you in the question as 1 billion class. As what? As
Hello,
1
sir.
billion.
Me, I'm not getting 10%. Oh,
Check your calculator now. Check. Others should check if they have the same thing. Please.
It's 10%.
It's 10% now. 1.2 times 5 plus 4 is what? I know is it comfort?
but I've gotten it.
Okay. Please, that your market woman calculator, I beg, change it. So now, number two, the total market value is given to you in the question, so you don't need to determine the total market value. Of course, I didn't mean it is not given. We have to determine the total market value, right? Now, number two, what is the net sources of finance? Number two, what is net sources of finance? Is from our table is convertible bonds, right? Class, convertible what? Convertible bond. This is where we will spend much of our time. Convertible bonds, right? Now, when you are to determine the cost of convertible bond, what will you use to determine the cost of convertible bond? Please, class. If you want to determine the cost of convertible bond, you will use what to determine the cost of convertible bond, class?
Current
IRR.
market value.
Away.
IRR.
Internal rate of
Yeah.
return.
Return.
Exclusive. Well done. So is what? Internal rate of what? Internal rate of return. Now, when you want to cook soup, you will look for ingredients. You will look for ingredients. Now, you will now look for what are the ingredients that you will use to determine internal rate of return. I usually call it ingredients so that you will remember. You will remember when you have a convertible bond, right? What are the ingredients? Now, please list the ingredients. I'm listening. So what are the ingredients you will use? Class, what are the ingredients to if you want to determine the cost of convertible bond? I'm listening.
Okay, we need
Okay,
the market value, the current market value.
okay, okay. The current internal rate of return.
Mm.
So we need which current market value? We need market. Why is this thing jumping? Okay, we need market.
Annual interest.
That's interest.
We need market value as interest, right? Market value
Mm.
as interest of the convertible bond, right? What do we need? We
Duration.
need
Annual
you pay
interest.
The duration.
interest. Thank you. You pay interest. Of course, you pay interest. Now there will be a tax
Tax relief.
relief on
Mm-hmm.
that interest, right? There will be a tax relief. Coming. I don't know why this thing is jumping. There will be a tax relief on the interest, right? There will be a tax relief on the interest. So tax, okay, tax tax relief on interest, right? Now you have the numbers of years. Then you have your convertible because this question did not indicate class. This question did not indicate two options for us. Don't forget that convertible bonds have two options. Either you convert it or you redeem it. Because the question did not give us the full information about the redemption, whether they redeem it at par or not. So since they didn't give us, we will just stick to our convertible value. We just go for convertible value. Don't forget that when you are given these two options, you look for the higher of the two, right? The higher of the what? The higher of the two. Now, let's move ahead. Let's move ahead. So, what is it called? The convertible value. This is what we need, right? This is what we need, right? Now, the question is that, class, Are we still together? The question is that this, what is it called? Equals to the market value S interest. Now, class, when you want to get your market value S interest, right? Let's quickly go to the convertible. What does this convertible says? The convertible says that the S interest market value of the convertible bond is what? Is 168 million, which is the total market value. Class, class, your class, listen, oh, your market value S interest per bond, that is what you will use to determine your internal rate of return. You see this total here is a trap. Don't go and use 168 million to calculate your internal rate of return. It will be very, very wrong. Just to save yourself stress, although you can still use it, but it will take much of your time. Now, the best thing for you to do is that you need to get the market value as interest per one of the bond. You know, this is total market value, class. Now, let me quickly bring it out here. Let me just put it here as total market value is equals to 168, abi? 168 million, right? Class, is it million? 168 million. Okay, 168 million. Now, this is market value, total market value as interest. As interest. Now, see, when you, the market value as interest that you will use is the one of per bond. Don't go and use the total, class. Don't go and use the total to save yourself stress. Use the market value as interest per bond, and this is the total. Now, how do we get the market value as interest per one of these per bond? Class, who can tell me how do we determine market value as interest per bond? How do we determine that? Who can try? Who can try, class? Hello?
We divide it's going to be the total value as interest divided by
Okay.
the number of bonds.
Thank you. And that is it. So that you will get market value as interest per bond. Let me include it per bond. Thank you. It is what? Market value as interest per what? Per bond. Now, what will you do is that 168 million divided by the numbers of convertible bond. Now, go to your capital structure. So what is this convertible bond? How much is this? You can see this is the total value. Is that not so? And this is the nominal value, right? Just use 160 million. This 160 million, divide it by the nominal value. We give you the numbers of convertible bonds. Class, we give you the what? The numbers of convertible bonds. Now, let's quickly bring it out again. Let's quickly bring that. That is very good. Now, I love that. Thank you. Now, you see numbers of convertible bond is equals to, right, total, let me bring it up, total value of convertible, right, bonds divided by the what? The nominal value of the convertible bond. Now, it is 160, right? 160 million divided by the nominal value is 100, right? Class, the nominal value is what? 100. Now, if you know, Naira can cancel Naira. Is that not so? Naira can cancel what? Naira can cancel Naira. 160 million Naira. 100 Naira. If you use Naira cancel Naira, you have what? Numbers. Class, these are the techniques. These are the techniques, areas you need to pay attention to. See, when they calculate something, you don't just calculate, you understand the basis, right? Now, what is the numbers? Class, what is the numbers? Please quickly give me figure. What is the numbers of convertible bond? Class, what is the numbers of convertible bond? What is the numbers of
1.6.
1.6?
600,000. Yeah.
1.6. Let me just use 1.6 million. Let's say 1.6 million bonds, right? Million what? Million bonds, right? Now, this is
It's
the numbers.
1.68.
It's 1.68. So 1.68,
Where is the 8
right?
coming from? It's 1.6 now.
It's 1.68.
160 divided by 100.
No, it is 168 divided by 100.
Is it 168?
Yes.
No,
Yes.
no. Don't use 168 divided by 100. We want to get the
Ah.
numbers of convertible
We are
first.
using the convertible now from the
Yes, the numbers. See,
financial
listen.
statement.
Thank you. The numbers of convertible first before we use that one. Rachel, we need to get the numbers of, for you to get the numbers of convertible first, you use the total value of convertible bond given to you in the financial statement. Divide it by
Okay,
the
sir.
nominal value. Do you understand?
Yes, sir. Thank you, sir.
Okay. Now, this is 1.6 million what? Million bonds, right? Million bonds, right? Now, if this is established, you already established the the numbers of bonds. Is that not so? Class. Now, to get your market value as interest per one, you will now do what? 19168 million divided by 1.6 million. Right? Bonds. Right? We give you what? So, what is the market value as interest per bond, class? Quickly. Hello.
105.
Thank you. 105. Just
105.
105. 105. 105 per bond. Right? Put it that way. Per bond. Right? Interesting. Now, what is your interest rate? Class, are we still together? See, the main problem of this question is convertible. The main problem of this question is what? Is your ability to understand the convertible bond. See, the next part now will take you on bond valuation. You will love it, right? When we get to bond valuation. Now, interest now. Now, you quickly go back to the capital structure, right? Where you will have interest attached to the what? To the sources of finance. Now, what is the interest rate? Is 7%. The interest rate is what? 7%. And the nominal value is what? 100. Now, you quickly go back. Now, class, if this is 7%, class, how do we convert this to naira? Who can tell me how do we convert this 7% to naira? How do we convert this 7% to naira? You have 7 over 100 times what?
Right, times 100.
Thank you. Times what? The nominal value. Now, if the nominal value of the convertible bond is 1,000, multiply it by 1,000 naira, right? Now, class, are you getting the logic? Times what? Times 100. Right? Now, when you multiply it, you have what? You have 7 naira. You have what? 7 naira. Your interest rate, you pay 7 naira, 7 naira, 7 naira on what? On interest. Now, equals to, now don't forget that your tax will be applied to, your tax will be applied on the interest, right? Your tax will be applied to interest, right? Now, what is the interest rate given to us in this question? What is the interest rate? Now, you come down, you can see that JP pays interest rate of how many percent? 30%. It will be that there will be a tax relief on the interest, which is that 30% of 0.3 times of 7 naira. What do we have, class? What do we have? Class, quickly.
2.1.
What do we have?
2.1.
2.1. 2.1. So this 2.1, that is what we use to reduce our what? That is what we use to reduce our interest rate. Now, don't forget that your market value will be at year zero. Let me be putting it. Year zero. Year zero. You pay interest. How many years? Let me quickly go back. I didn't even know the numbers, or they didn't tell us how many years, how many years, how many years. The
5 years.
convertible. Okay, where is it to? Where is the 5 years?
5 years.
It's 5 years. Me, I didn't see 5 years. So, hey, wait, where is it, sir? 5 years, right? Where is it? Please, where is the 5 years?
Redemption date are both on the same date in 5 years.
Okay, thank you. Thank you, Redemption. Omo. I'm looking for 5 years. See, so thank you, thank you. God bless you, exclusive. So now you have 5 years, right? So you pay interest from year 1 to year 5, right? From year 1 to year 5, right? Now, this there will be a tax relief on all the interest from year 1 to year 5 as well, right? Now, the numbers of years is 5 years. Is what? Is 5 years. Class. Now, how do we now determine the convertible value, which will be like a principal at the end of the maturity? Now, how do we determine the what? The convertible bond, convertible value. Now, don't forget that in this question, conversion ratio is given. Please, can someone give me the formula for calculating convertible value when conversion ratio is given as well as the growth rate is given? Quickly. I need the formula. Give me the formula. Hello? What is the formula, class?
For the
The number of shares.
DO, DO bracket
The number of
1
for
plus G
convertible value,
times half. Okay.
Okay, thank you. Thank you. Okay, now, for the convertible value, you can use PO or you use VE, which will be easy for you. Check the material and as well check our previous class. Growth rate, right? Then R is the conversion ratio raised to power n, right? This will give us what? This will give us let me raise to power, yes. So this will give us what? The convertible value. Because why do we have to use this? Now, it is not all case. All cost of capital question you will have
It
conversion
is to
ratio.
power n.
Yeah, it's there. Raised to power n is there. So it is not all bond question, all cost of capital question you will have growth rate or conversion ratio, right? Sometimes the convertible value, they may tell you that the convertible value is at par, which is just 100. Then you just use it and move on. Now, they can tell you that the convertible value is 1,000. You just do it and move on. But in this question, it is not given like that because the growth rate and all those elements is given. Now, class, what is VE? VE is what? VE is, what is VE? VE
just
is
to work
equals to
for
what?
it.
Convertible
VE,
value.
VE is equals
Okay.
to, no,
You have to
V,
work it out now.
market
The
value.
market value over the number of.
The market value, expected market value.
okay, that is market
One.
value. Thank you. Market value, thank you. Market value of equity per shares per one, right? G G is equals to the growth rate, right? The growth rate, right? G is equals to what? The growth rate. N is equals to numbers of years, right? The R is what? Is equals to conversion ratio. Conversion ratio, right? Now, class, we need to go back to equity, right? We need to go back to equity because the market value given to us in this question is in total. The total market value, they give us the total market value of equity, of which we don't need the total value of equity here. Now, let's quickly go back to equity, because what we need here is market value of equity per one of the shares. Now, I need to get the numbers of shares. Now, let's quickly go back to what we did in the now, you can see this 1 billion. Are you there? It is the total market value. And what we need, right, class, what we need is market value of equity per shares. Is that not so? Now, what do? We need to get the numbers of shares. Class, how do we determine the numbers of shares? Numbers of shares under equity. Let's quickly go back to capital structure. Numbers of shares. Who can tell me?
Nominal
Numbers of
value.
shares. Numbers
The
of
nominal
shares.
value.
Numbers of shares.
Divide
The cost over
1
the
billion
nominal
by the
value.
nominal.
Okay, you say what?
200 million over
Divide
1
1
million.
billion
Thank
value.
you. Thank you. Thank you. The total value of ordinary shares, which is
200 million.
200, divided by the nominal value. I don't need to write this one out. This one will give you the numbers of shares. And the numbers of shares is what? Is
200
200
million.
million. Are we together, please? Now, I don't need to
Yeah.
write this out. So maybe when you listen to the video, you can put it in your notes, right? We give you the what? The numbers of shares. So for you to get the market value of equity per shares, you need to divide it 1 billion, right? 1 billion divided by
200 million.
200, right? 200 million
Yep.
shares. In case you are wondering how we get 200 million shares, go back to your equity, right? Total value of equity 200 million, divide it by the numbers of shares, by the nominal value. Divide it by the nominal value, you get your numbers of shares. Class, what is the market value of equity? Quickly.
5 naira.
5 naira. Thank you. 5 naira. Thank you. Oh, this call will end in 11 minutes. Please, when it is exactly 5 minutes, let me know. Okay. Now, if this is established, you have 5 naira per shares. Right? Now, we move on. What is the growth rate given to us in this question? Let's quickly go back. What is the growth rate given to us in this question?
4%.
Thank you. You can see the growth rate in the forcible feature is what? Is 4%.
4%. Yeah.
Okay. Thank you. Okay, 4%, right? Now, the growth rate is 4%, right? 4%, right? Or you say 0.04, right? Now, if this is established, the numbers is 5 years, right? Now, what is the conversion ratio given to us in this question? What is the conversion ratio,
19.
class? 19.
19.
God bless you. 19. What is the conversion ratio? Is what? Is 19. Now, you cannot put all this in this formula to get your convertible value, class. Now, convertible value now, convertible value is equals to VE.
115.
VE is 5 naira, right? VE is what? Is it not 5 naira?
5 naira. 5 naira.
Thank you. 5 naira. Please, others should confirm. 5 naira. You open the bracket, 1 plus the growth rate, which is what? 0.04. You close the bracket. This question is a wicked question because they want to test your ability, right? Now, you close the bracket. We've not even calculated the IRR. You close the bracket, raised to power what? 5, right? So, raised to power of 5, right? Coming. Raised to power of 5 times 19. What do we have? Times 19. What is the conversion value?
115.6.
Times 19, right? Times 19. I'm coming. Okay, what do we have? 105, right?
I have 115.58.
So others should confirm as well.
Yes, it's correct.
What do we have?
Yes, it's correct.
115.58.
Okay, 115, right? 115.
0.58.
It's 115.5.
0.58.
Yeah.
Okay, thank you. All right. Now you cannot use internal rate of return. Don't forget the logic for the internal rate of return. Don't forget the logic, right? The lower the rate, the higher the MPV. Is that not so? The lower the rate, the higher the what? The MPV, right? And the higher the rate, right? The lower the what? The lower the MPV. So we can now do positive MPV and negative MPV. Let me see if we can quickly do that before we create another link, right? So now we move to positive and negative MPV. Now we'll start with uh, MPV, right? So what do we need? Yes, items, the cash flow. Please always write it in full. The cash flow, right? After the cash flow, DCF, trial and error, the PV, which is the present value, class. Now, we will now start coming, which is the present value. So we move on. You start with year 0. Don't forget your market value. Your market value as interest will be at what? Will be at year 0. Class will be at your what? Year 0. Market value as interest. Interest, right? Will be at what? Will be at year 0. Now, what is the market value as interest? The market value as interest, we've calculated it already, right? We've calculated it already as this, right? This is 105. 105. 105, right? So if this is 105, okay, is it exactly 5 minutes? So we can use 4%. We use 4% here. We use so that you give us, is it exactly 5 minutes? Class, is it 5 minutes?